Now, anything but cash. That's what the French banking giant SocGen is advising its clients. But if not cash, how should investors play 2010? My colleague Stefan Pedrazzi caught up with the bank's chief strategist to get his must-have trades for 2010.
The market consensus is that we are going to leave a bond market crash in 2010. However, the growth is going to come in the US. We're going to have employment growth. We have growth in emerging countries, so there is a growing momentum for global growth. Nevertheless, the fear of a double dip will prevent a bond market crash, as the Federal Reserve is going to stay on a zero-rate policy for a much longer period than the market expects, and the carry effect, so to play the yield curve on bonds against short-term rates, is going to be very attractive.
Now, talking about investment strategy, your main advice for this year is anything but cash.
That is the consequence of the first idea, that central banks on the J4 countries are going to stay on a zero-rate policy for a much longer period than market expectations. That means the remuneration you get on cash is very limited, if not zero. So to get out of cash and to reinvest that in bonds, but also in other risky asset classes, should be the strategy to implement this year.
And how do you see interest rates at the end of this year?
I would expect the Fed to announce from summer that in Q1 2011, they will start the tightening process from the rate policy. So the change of message would happen from summer, but to implement it at the end of the year or early 2011.
And what about the European Central Bank?
It will not be that different. We all know that if the Trichet from Frankfurt was to tighten before the Fed, that would trigger a shoot-up of the euro, which would become acceptable to the Eurozone.
How do you see currency market this year? We recently had plenty of comments from French politicians, from the President, Nicolas Sarkozy, from the Finance Minister, Christine Lagarde. How do you see this market in the next coming month?
I would expect the J4 currencies this year to remain at zero rate. So the debate would not be, as such, the interest rate policy. Nevertheless, I would expect the carry currency, in which the markets are borrowing, to switch from currently the US dollar. When the Fed changes the message in summer, then the market will switch into the yen then becoming the major carry currency. So I would expect overall the US dollar to be around flat against the euro, but I would expect massively the yen to fall, and it will become back with the status of the borrowing currency for global markets.
And for more of SocGen's best plays for 2010, please visit the website europe.cnbc.com. Find out why you should be a commodity bull this year. Right.